Hello, hi. Welcome to our next video, which is variable and absorption costing. Okay, so this is the second presentation in CMA Part 1 Section D, which is variable and absorption costing. So here actually we are discussing about how we deal with overhead cost in two different methods of costing. So we talked about overhead cost in the previous videos, and we allocated overhead cost to the products, and we found what was underapplied or overapplied. Then we adjusted those to our cost of goods sold or maybe inventories. So that we have seen in previous videos. Now this is talking about different two methods of costing, which is variable and absorption costing. Variable and absorption costing. Okay, so before we go into details, let's remind about ourselves. What is overhead cost? The cost not directly related to the manufacture of a product or delivery of a service, or cost that cannot be traceable, right? This we have seen. There are some costs we cannot trace to the units what we produce. That is what we call it as overhead cost. Example is like rent, what we pay, electricity, etc. Now in this we have two types of cost. Overhead cost can be classified into two. One is fixed overhead, other one is variable overhead. Fixed and variable. So overhead that does not vary as a result of variation in activity level. Like our activity level means production. If the production is increasing or decreasing, this cost is not changing. That is what we call it as fixed cost. So it has nothing to do with our activity. If you make 0 unit, if you make 1 million units, you have to pay factory rent. So that rent is fixed. That is what fixed factory overhead is, or fixed overhead we can say. Now what we have is variable overhead. These are again indirect cost of operating a business that fluctuate somewhat. Not like variable cost or direct cost is, it will vary along with the number of units produced, but it will vary somewhat, but are incurred even if business activity is minimal. For example, electricity, you have to pay a certain amount even if you don't use any electricity at your premises, right? Certain amount you have to pay. But when you consume more electricity, you have to pay more. So that overhead we can consider as variable cost, because it is going to change somewhat based on our activity level. So this is what actually fixed overhead and variable overhead. So variable overhead normally consists of indirect material, indirect labor and other cost that cannot be directly allocated to a product that we know already. We have seen this in our previous presentations. So now we have understood what is fixed overhead and what is variable overhead. Now we will go and discuss about what is variable and absorption costing. So this costing have some differences. Variable cost and absorption costing are two methods of costing, and these are different in two ways. There are two differences normally we will find in variable and absorption costing. One is how they treat fixed factory overhead, such as factory rent. How both the methods are going to treat fixed factory overhead. That is the first difference. The second is how the income statement is presented. So there will be slight difference in how the income statement is presented. So you have two differences. One is how they deal with fixed factory overhead. The second one is how they prepare income statement. Okay, and variable costing, sometimes it is also called as direct costing. And as per US GAAP, as per the standards, we have to follow absorption costing. As per the standards, we have to follow absorption costing. But variable costing, it can be internally used for better decision making or better analysis. We can use variable costing. How? That we are going to see in the coming slides. So here again, we said the first difference is how both methods are treating fixed factory cost, right? So how it will be treated in variable costing? In variable costing, fixed factory overheads are treated as period cost and expensed as they incurred, right? We have discussed about period cost. Period cost means you will expense those amount incurred in the same period of occurrence. It won't be added to inventory. It won't be absorbed by inventory and stayed in the balance sheet. No, it is going to be expensed as it is. For example, rent paid, you will debit rent, you will credit cash or credit bank. You are not adding this to inventory. That is what period cost is, right? Whatever you spend, it is recorded in the same period. But when it is absorbed, what will happen? When it is absorbed to inventory, that will stay in balance sheet until it is sold. So if it is not sold this year, this expense will be going to income statement next year if it is sold next year. Okay, that is what absorption costing is. It is not directly going into income statement in the same period. It will be going to income statement when actually the goods are sold. This we discussed already earlier. So that is what under absorption costing, fixed overheads are allocated to units and that were produced during the period. So what does that mean? This means that fixed factory overhead cost will go first to balance sheet in the form of inventory, then flow to income statement as cost of goods sold when it is sold. If it is not sold, the rent what you absorbed to your inventory is in the balance sheet. There is no expense because it is not sold. When it is sold, all those costs will go to income statement in the form of cost of goods sold. So this is the main difference between variable costing and absorption costing, how they treat fixed overhead. So in variable costing, whatever you spend, for example, rent you paid, you will directly debit rent and credit bank. It has gone to income statement. But in absorption costing, this rent what you paid, you will inventory it. Or we can say you will add that to the products. How we have seen before, we will add this to overhead control account. From overhead control account, it will go to work in progress, then to finished goods. Once it is sold, it will go to cost of goods sold. If it is not sold, it is in the balance sheet. So that means the rent you paid is in the balance sheet, not in the income statement. That is the main difference between variable costing and absorption costing. But if everything is sold, whatever you produced is sold in the same period, then there won't be any difference between two methods. Why? The rent you paid, that first went to balance sheet in the form of inventory, then when it is sold, it went to income statement in the same period. So if everything is sold in the same period, there won't be any difference between these two methods. But when you have ending finished goods, then you will have difference in these two methods, because some of the cost what you spend is carried in the inventory and it is in the balance sheet, it is not going to income statement. So over the long term, both methods will provide same total income, and this difference is only a timing difference. So what does that mean? Like if I produced 1000 units this year and I sold 500 this year and sold 500 second year. So if you take that income of total 2 years, there won't be any difference between variable costing and absorption costing. Why? Whatever I produced, everything is sold. So everything has expensed. But half is expensed in the first year, half is expensed in the second year in case of absorption costing, but all the amount is expensed in the first year in case of variable costing. So that is the difference in absorption and variable costing. So under variable costing, only those costs of production that vary with output, or only variable cost, are treated as product cost, or only direct cost will be treated as product cost. Sorry, not variable cost, only the direct cost will be treated as product cost, because that is varying with output. So this cost normally incur what? It will consist of only direct material, direct labor and variable manufacturing overhead. So fixed manufacturing overhead is not treated as a product cost under variable costing. Rather, it is treated as a period cost. This is what we have seen earlier. Fixed manufacturing overhead won't be treated as product cost, but it will be considered as period cost in variable costing. But in absorption costing, it will be considered as inventoriable cost or product cost. And we said variable costing can be used internally only, not for external purpose. And absorption costing treats all production cost as product cost. So every cost will be considered as product cost, anything related to production. So units produced under absorption costing method consist of direct material, direct labor, and both variable and fixed manufacturing overhead. So this is the difference. Here fixed manufacturing cost is also included in the production, but in variable costing that will be considered as period cost. So because of this, some of the fixed cost will be in your balance sheet if the goods are not sold. So under absorption costing, a portion of the manufacturing overhead is allocated to each unit of product. So fixed manufacturing cost will be allocated to each unit of product. If it is not sold, that cost is not going to income statement until it is sold, and this is GAAP preferred. So that was the first difference, how the fixed overhead is treated in both methods. In variable costing, fixed overhead is period cost, and in absorption costing, it is considered as a product cost. Now, we said the second method is how the income statement will be presented. Under absorption costing, the income statement is broken down into components based on whether costs are manufacturing or non-manufacturing. So under absorption costing, your segregation of cost is based on if it is manufacturing or non-manufacturing. You can see here sales revenue, then you will take all the manufacturing cost, including fixed manufacturing. That you minus, then you will get gross margin. Then you will minus variable non-manufacturing cost and fixed non-manufacturing cost. This is how you will get operating income. So you can see here both are non-manufacturing cost because all the manufacturing cost has gone here, and you found gross margin. and you will minus non-manufacturing cost to find your operating income. But under variable costing, the income statement is broken down whether the costs are variable or fixed. You can see here, first you have sales revenue, then you have only variable manufacturing cost. That means this is not including fixed manufacturing overheads. Then you have something called manufacturing contribution margin. So what is contribution margin? Sales value minus variable cost is what we call it as contribution margin. So here manufacturing contribution margin you will get, then you will minus now variable non-manufacturing cost. Now you are reducing all the non-manufacturing cost which is variable, then you will get total contribution or contribution margin, we can say. So now from this contribution margin we will minus fixed cost. Then you will get your operating income. So here segregation is like whether it is variable cost or fixed cost. But here segregation is based on if it is manufacturing cost or non-manufacturing cost. So this is the difference in presentation. So that much only related to this topic, and we can see one example and we can finish it off. So here we can see there is a company that is selling ladders at $200. Okay, and variable cost per ladder is $100. These are the variable production cost, and you have annual fixed production cost which is 360,000. This is your annual fixed cost, or this is the fixed overhead, and you are producing in the first year 10,000. So this 360,000 will be divided by 10,000, not 9,000, divided by 10,000, you will get 36. Okay, for one unit it is 36. Second year you produced 8,000 units. So this 360,000 will be divided between this 8,000 unit, and per unit you will get $45 fixed overhead rate. So that is the fixed overhead rates. First year it is 36, second year it is 45. And you can see here, though you produced 10,000 units in the first year, you sold only 9,000. And in the second year, though you produced 8,000 only, but you sold 9,000. That means you sold 1,000 units more than your production. How you sold it? Because it was there in the beginning inventory, or it was there in the store from last year. So this is the scenario, and we have to prepare or we have to find out the difference between income statement under both method. So just look at this example once more. Units sold is 9,000, produced is 10,000, and in the second year sold is 9,000 but produced only 8,000, that is 1,000 less than your sales. And this is the selling price 200, and variable cost is 100, and this is the fixed cost. Now we will see under variable costing what we will do. We will take 9,000 units what we sold here multiplied with 200, we will get 1.8 million as the sales. Then we will take 9,000, multiply that with 100, that will give you your variable cost. So sales value minus variable cost, you will get contribution margin. So as I said, contribution margin is sales minus variable cost. We will discuss about contribution margin later in detail. So this is your contribution margin, and you have a fixed cost of 360,000 that you will minus, you will get operating income of 540. This is what under variable costing for year 1, and year 2 also same scenario, because you can see the unit sold is same 9,000 and 9,000 multiplied with 200, then 9,000 multiplied with 100, then minus 360,000, you will get 540. Here we can see fixed cost of production, we are completely removing here, we are expensing it out completely in the same period. We are not adding anything to inventory. But if you look at absorption costing, sales revenue is same as we have seen, and variable cost of goods sold is same, that also we have seen, but here you have a difference. Fixed cost of goods sold, here it is 324, but here it is 360. Why is that? Because all the cost of 360,000 we are allocating to the units produced. How many units produced? 10,000 units produced. So that means every every unit will get $36 of cost. Or we can say every unit produced, you will add 36 units to $36 to the units produced, and you will carry this inventory in the balance sheet. When it is sold, all this cost will go to income statement as cost of goods sold. But you are not selling all, you are not selling all goods. You are selling only 9,000 units out of 10,000. That means 9,000 into 36 only will go to income statement, and the rest 1,000 multiplied by 36 will stay still in the balance sheet. That is why here you have only 324,000 as the fixed cost of goods sold, fixed overhead. Or we can say 36 multiplied by 1,000 is absorbed in the balance sheet or absorbed in the inventory. It is not gone to income statement. So that is what here we mentioned, fixed cost absorbed. In the first year it is absorbed in the inventory 36,000. It has not released to income statement. When it will be released to income statement, we can see here second year we sold 9,000, but how many we produced? Only 8,000. That means whatever there was left last year, that you sold this year. So this year you sold 9,000, but you produced only 8,000. So all the cost of 360,000 for the current period plus the cost of this 1,000 multiplied with 36. So 360 plus 36, it will go to income statement in year 2. So here your cost is higher in the second year, but here your cost is lower. But if you take the total cost and total profit, it is going to be same if you take the total for 2 years. As I mentioned earlier, it is only a time difference. So in the second year, what we have seen here is, or what we can see here is, we are releasing some fixed cost which was absorbed in the first year. So absorbed 36,000 in the first year, released that in the second year, and if you take the total income statement or total income for 2 years, the amount is going to be same. So this is the difference between variable costing and fixed costing. So here we have one more example. For example, first we produced 12,000 and 9,000 sold. Second year we produced 12,000 and 9,000 sold. So here per unit overhead, first year 36 and second year it is 30. So if you observe this, I produce 10,000 and sold only 1000. That means 1000 multiplied with 36, that will be absorbed in the inventory and will stay in the balance sheet. Correct? 36,000 will be in the balance sheet. When you are selling 9,000 in the second year, we are assuming that this 1000 is the first 1000 we will sell it off. So this cost will be released in the second year, and out of this 12,000 we will sell the rest of the 8,000. So 1,000 from the last year we sold, 8,000 from the current year, and 4,000 is still in the inventory, and 4,000 multiplied with this 36, that will be absorbed to inventory and will stay in the balance sheet. Okay, how it will be done? Once more we can see an example. So variable costing, I don't think it is a problem for you. So it is same as last example. Absorption costing, you can see again your selling value same, variable cost is same. But here your fixed cost is 324,000, same as we have seen in the last slide. 324,000. And now what is happening in year 2? Year 2 you sold 9,000 units. Okay, but 1,000 was from the last period. So 1,000 multiplied with 36 from the last period. Rest of the 8,000 multiplied with 30, that will be coming into current period. So both of this amount, 36,000 from the last period and 8,000 multiplied by 30, 240,000 from this period will come as fixed cost here. So 240 multiplied by 36 will be 276. Again, there is a difference. But if you take the total difference, it has to be same if everything is solved. But here we didn't solve everything. 4,000 is still there. So you will have differences between your income statement, because 4,000 unit is still carrying the fixed overhead cost in inventory. So this is the second example, and here we can see how much is absorbed and how much is released. In the first year, 1,000 units into 36 multiplied with 36, 36,000 is absorbed. 36,000 is released in the year 2, and in the year 1 you absorbed 36,000. In the year 2 you absorbed 120,000. So there will be difference of 120,000 if you consider both method. In the first year you released, in the second year you release this 36,000. So this is how you will be calculating income statement under absorption and variable costing. Now there is a shortcut if you want to find out the difference between two income statements. So we know that the difference is happening because of how much fixed overhead is carried in the balance sheet, right? So how much fixed overhead is carried in the balance sheet, how we will see? We will see how many units of inventory is there in the balance sheet, multiply that with per unit of fixed overhead. Then you will get the difference between both. So this is the type of question you will get. So you have to find out the difference between absorption costing method and variable costing method. Quickly, you can use this method. You can take fixed overhead cost per unit multiplied with number of units or number of units change in inventory. So we can go and see the example here. Now what is the difference here? it is 504, here it is 540. So difference is 36,000. How this 36,000 difference happened? Because you absorbed in the first year 1,000 units, and each unit's getting $36 of fixed overhead cost. So that is how you got this difference. So that is what it is mentioned here. You can calculate it using this formula. Fixed overhead cost per unit multiplied by number of units of change in inventory. If inventory is increased or if the inventory is decreased, that's what change in inventory, there will be a difference. The income statement may be more profit showing, or income statement will be showing less profit based on change in number of units. But this will not work always. If this need to work, we have to meet this condition. First of all, there is no beginning inventory, then it will work out. Because I was having 0 in the beginning, now I can see 1,000 in my hand. So 1,000 multiplied with, in our example, 36, we can find out the difference between both. But if there was 1,000 in the beginning, now I have 800. Okay, so there is a change in inventory, but we have to do some calculation here because there was some inventory in the beginning. And also we have to find that what was the cost of the overhead applied for beginning inventory and what is the cost of overhead applied in the current period. If this is different, then this calculation will not work out. The cost has to be same, but only in case of LIFO, if the inventory is higher than beginning inventory, then you can do this calculation or you can use this shortcut. If you are following LIFO means last in first out. I was having 100 in the beginning. Now we can say I have 200 at the end. So that means there was 100 in the beginning and I produced a lot. Still my ending inventory is 200. And we believe that we are selling whatever we produced last in first out. So whatever we sold during this period is the items we produced during this period. We can assume that, right? If we follow LIFO, last in first out. All these cost flow methods of inventory and all we'll be studying in section A of part 1. If you know about these concepts, you can try to understand that. Otherwise, forget about it now. We will explain that or we will learn that later. If you follow any other method, then the beginning inventory valued at same overhead rate as the current year's rate. It has to be same rate previous year and this year if you follow any of the method, and whatever under and over applied fixed manufacturing overhead has to close out to cost of goods sold. So we have seen that under and over applied fixed overhead, if it is material, we will segregate or we will distribute that proportionately between finished goods, work in progress and cost of goods sold. So in that case, again, it will not work. If all the cost is, all the over or applied fixed overhead is closed out to cost of goods sold, in that case only this shortcut will work. Okay, so forget about all these things. You just have to remember this, because almost all your question will say that they follow LIFO or either this cost is same. So there is, I didn't see any question that is not matching with this shortcut. Okay, so your shortcut is to find the difference between variable costing income statement and fixed costing income statement is just take the number of units at the end of the period, multiply that with fixed overhead cost per unit. Okay, so that's it about the difference between variable costing and absorption costing. And here we have some more topics to discuss, like this we already know, but just I am emphasizing these things in your mind. When inventory increasing means your production is greater than sales, right? I produced 1000 and my sale is only 800, so inventory is increased, right? Inventory is more with us now. So when inventory is increased, that means some of the cost is in the balance sheet, because in the balance sheet your inventory is increased, so that much cost will go to balance sheet. Or we can say that much cost has not transferred to income statement. Because of that, you will have higher income for this period when your inventory is increasing and you follow absorption method. Your inventory is increasing and you are following absorption method, then you will have higher net income, because some of the cost is still in the balance sheet. But if it is opposite, inventory decreasing, I was in the beginning I have 100, now I have only 50. What does that mean? Whatever I produced this year I sold, and also I tapped into last year's inventory and I sold 50 units from that. That is how I got this balance. That means I sold inventory belongs to last year also. So whatever cost was absorbed by the units in the last year will be released this year. So that means more of the cost will go to income statement this year, because more units we sold than the production this year. So your net income will be low if you follow absorption method. So it is opposite of inventory is increasing. When the inventory is decreasing, you are selling last year product also. So that means last year's fixed overhead cost per unit will come to income statement this year. So this has to be kept in mind, and this will help you to solve a lot of questions. Here there is one more point to discuss. Under absorption costing, a company can manipulate income. We know that if you produce more units, more cost will go to all the inventory what you produced. Or we can say like this: if I have $100,000 cost, that is my fixed overhead cost, okay, and I produce 100,000 units, so every unit will get $1 of overhead cost, which is fixed overhead. If I produced 200,000 units, then every unit will get $0.50 of overhead rate. Correct? 100,000 was my overhead cost, and that I am going to distribute now towards 200,000 units. That means every unit will get $0.50. So if you sold all 200,000 units, that means all the cost will go to income statement. But if you sell only 100,000 units, the half of the cost will stay in the balance sheet. So some managers or some people can manipulate their income statement. How? By just increasing the production. So when they increase the production, what will happen? The number of units will increase, or your change in inventory is now increasing. Your change in inventory is an increase in inventory now, and more of the cost will go to balance sheet from your overhead cost, fixed overhead cost, and it will stay in the balance sheet. It is not transferred to income statement. So your income statement will look good because more of the cost is still in the balance sheet. So this way, by just by increasing the production, you can reduce the cost and you can increase the net income. But over the long period, if you take, it is going to be same. Again, it is for a short-term period, or we can say it is a time difference only will happen. If you take long periods, then it is going to be same. And also, the ending inventory under absorption costing normally will be higher, because under absorption costing, even fixed overhead cost is allocated to inventory. So normally ending inventory will be higher in absorption costing. The cost of ending inventory will be higher. And this is the difference between variable and absorption costing, some benefits and drawbacks of both methods. So though absorption costing is required by US GAAP, variable costing is generally considered to be better for decision making. So for decision making purposes, we will consider variable cost as a better cost. Why? Fixed cost based on increase in our efficiency or decrease in our efficiency. Fixed cost we cannot change. It is not easy to change our fixed cost. But other variable cost, that is based on the decision what we are making, or based on the strategies we are implementing in the workplace, that we may be able to change, and that way you can make better decision based on the cost which is changing. But when the cost is fixed and that is not going to change based on whatever decision you make, then that is not relevant in your decision making. So that's what here, fixed cost is not relevant in your decision making. So you are excluding that from the cost of production, and based on this you can look at your efficiency of production, and you will be able to get a better picture when fixed cost is kept aside. And under variable costing, operating income is influenced by the level of sales only and not based on the change in inventory levels. So as we have seen, somebody can manipulate the income statement by just increasing the production in an year, because most of the cost he is planning to keep in balance sheet. But under variable costing, that is not possible, because your operating income is influenced only by how many units you sold, not by how many units you produced. And variance analysis, again this we will be studying in section C. Under absorption costing is going to be difficult. So if you want to find out what is the variance between your budget and your actual values, then that is going to be difficult under absorption costing, because you cannot segregate the material cost and labor cost and variable overhead and fixed overhead separately, because there you will show cost of goods sold. But under variable costing, you are showing that separately, right? Variable cost is shown separately, so the variance analysis is going to be easy for you, that we will study in the coming chapters. The impact on fixed cost is visible under variable costing. Variable costing is showing your fixed cost separately. So how much the rent of your factory is increasing your impacting your profitability, that you can understand if you follow variable costing. But under absorption costing, you cannot see rent separately, because that is added to the product. Again, that will impact your decision making. And it is easier to calculate contribution for a division of a product when you follow variable costing method. So contribution margin can be easily calculated when you follow variable method. Variable costing facilitate CVP analysis because it uses contribution approach. Again, this is a later topic that we have to discuss, what is CVP analysis. So you can just understand now that variable costing is facilitating CVP analysis, because here you can find out something called contribution margin. And variable costing mitigates the effects of earning manipulation because fixed manufacturing costs are not inventory. So the manipulation is not possible under variable costing. So merely by increasing the production, you cannot boost the net income. So that is what the differences between two methods. And this is a summary of whatever we discussed till now. And I hope you understood this clearly. And thank you for watching this, and thank you for being with me. Thanks a lot. See you in